So the US government just had to promise lenders the most interest it's paid to borrow in 19 years. 19 years. The last time it cost America this much to borrow for 30 years, the first iPhone hadn't shipped yet. And what's strange is that this is happening in the same week the stock market hit a brand new all-time high. Your 401k is having a party while the bond market is pulling the fire alarm. And both of them can't be right. The 30-year Treasury yield hit 5.3% this week, its highest since June of 2007.
The yield on the 30-year U.S. Treasury bond has hit its highest level since 2007, as investors remain very worried about inflation and government borrowing.
And at the same time, Reuters reported the S&P 500 closing at a record high.
Wall Street's main indexes ended higher on Thursday, with the Dow ticking up marginally, the S&P 500 adding nearly 0.2% to close at a record high, and the tech-heavy Nasdaq climbing more than 0.8%.
Two headlines, same week, telling opposite stories. Now, if you're thinking, okay, bonds and yields, who cares? Stay with me for 1 minute. Because that 30-year yield is the quiet number that sets the price of your mortgage, your car loan, the interest on the country's debt as it climbs toward $40 trillion. And this is the part almost nobody is connecting, the value of the exact AI stocks driving this rally. When this one number moves up, it reaches into all of it. So the mystery is simple. Why is the safest asset on Earth selling off while the riskiest stuff is melting up? And which market is telling the truth? There are two theories here. Theory one comes from the bulls. This is a healthy reset. The economy is strong. Tech earnings are real, and higher rates are temporary. Keith Lerner, the chief market strategist at Truist, is in this camp. He called the recent tech pullback a healthy reset and says AI is still the dominant theme of this bull market.
Forward earning estimates for the S&P back in February were starting to move down. That's part of the reason why we downgraded stocks. Now they have inflected higher. A lot of that is being driven by tech and communications, and that's the final point. You know, we had all this tariff uncertainty, right? The big T was tariffs. I think what the market has found over the last few months is the other T, technology and AI, which has been the dominant theme of this bull market, is back in the forefront.
Theory two comes from the worriers. The bond market is pricing in something the stock market refuses to see: sticky inflation, too much debt, and a Fed that has lost the plot. Mark Zandi, the chief economist at Moody's, called it a serious mistake by the Federal Reserve. Two smart camps, opposite conclusions. So in today's video, I want to show you what happened, why a boring government bond is suddenly the most important chart in finance, what it means for the dollar, the markets, and our investments, and how all this could play out. So, with that said, let's get into it. Hi, my name is Graham Mercer. Hope you're doing well. Come for the finance, and today we'll be tackling the 19-year high nobody's talking about. Now, before we get into why this is happening, I want to give you a little context because the whole story sits on one idea. So here it is. A bond is an IOU. That's it. When the US government needs money, it sells you an IOU called a treasury and promises to pay you back over a specified period of time and with interest along the way. That interest rate is the yield. And here's the thing about the yield. It moves opposite to how badly people want the IOU. When everyone wants to lend to Uncle Sam, the government offers a low rate and people still line up. When lenders get nervous, they demand a higher rate to take the risk. So a rising yield is not random. It's the sound of lenders getting nervous, right? And on the 30-year bond, they are more nervous than they've been since 2007. So then the question is, nervous about what? And this is where it gets interesting because it isn't one thing. It's three, all pushing at once. Number one, this isn't only an American story. Japan, the UK, and Europe, their long-term bonds are all selling off too. UK 30-year borrowing costs are pushing toward 6%. Japanese yields are near an all-time high. And when the rest of the world demands higher interest, America has to compete for the same lenders. Mark Newton, the technical strategist at Fundstrat, put it this way: Japanese yields pushed higher, and it spilled right over into U.S. markets. Prashant Nunaha at TD Securities said it even more plainly. Japan was meant to be the anchor for global rates, and if that anchor lifts, everything reprices, which is to say the floor under the whole world's borrowing costs is moving up. Number two, and this one is counterintuitive, the problem might be that the economy is too strong. See, normally, weak data pushes yields down, and we did get some soft numbers. July retail sales were the weakest since May of last year, but yields didn't fall. Deutsche Bank's macro strategist Henry Allen explained why. When growth holds up and stocks sit at records, financial conditions stay loose, which keeps demand up, keeps inflation sticky, and can force the Fed to hike more, not less. In his own words, current pricing is leaving almost no margin for error, and the data feeds the fear. Inflation was still running at 3.4% in July, above the Fed's 2% target. Deutsche Bank points out that historically, when inflation runs above 3%, the Fed has ended up raising interest rates more than a full percentage point. Markets are now pricing roughly a 31% chance of a rate hike by year end, not a cut, a hike. Number three is about supply, and this is the one I want you to pay close attention to. The government is issuing a mountain of long-term debt to fund its deficits, and demand is thinning out. This week's 30-year auction cleared at the highest yield since 2001. The old reliable buyers, foreign central banks, and pension funds are stepping back. The Treasury's own data this week showed the UK, China, and Japan all cut their holdings in June. So who's left to buy? Private investors. And they want to be paid more. Anshul Pradhan at Barclays estimates that shift from price-insensitive buyers to return-hungry ones has added about 90 basis points to the 30-year term premium over the last decade. Now layer the Fed on top. On July 29th, they held rates for the fifth straight meeting, and Chair Kevin Warsh refused to tell markets what would make him move. That silence is why Zandy at Moody's called it a serious mistake. And it's why Bank of America warned, and I want to read this one exactly, that the Fed now shows a growing credibility problem, the kind of price action you'd normally see from an emerging market central bank. That is a stunning thing for Bank of America to put in writing about the Federal Reserve. So let's bring this home, because here's where it reaches your wallet. That 30-year yield is the anchor for the 30-year mortgage. It's the discount rate that decides what a tech company's far-off AI profits are worth in today's dollars. And here's the connection almost nobody is making. The AI trade, the thing pushing your index fund to all-time highs, runs on cheap money and the promise of future profits. Goldman Sachs research estimates U.S. companies will spend $581 billion on AI this year alone. The four biggest are on track to spend around $740 billion on AI infrastructure this year and close to $1 trillion next year. And they're not paying with cash anymore. Alphabet just posted its first negative free cash flow as a public company. Maria Lorena at Domini Impact Investments said it cleanly, that spending is tipping over into the companies raising debt, right as the cost of that debt hits a 19-year high. You get the idea. The party music and the fire alarm are basically wired to the same switch. So here's how this could play out. Two scenarios. Scenario one, the calm version. The tech giants have enormous earnings and strong balance sheets. They can carry the debt. Inflation drifts back down, oil settles, the Fed quietly stops hiking, yields level off. The party goes on. Scenario two, the warning. Yields keep grinding higher. Fundstrat's Newton sees 5.6 to 5.7% on the 30-year. Higher rates finally bite the AI valuations that are priced for perfection. A soft auction or a hot inflation print becomes the spark. And as Deutsche Bank warned, with no margin for error, stocks and bonds fall together. The loudest bear, Peter Schiff, calls the market a ticking time bomb. In fairness, Schiff has been saying that for a while and the market kept climbing, so take his timing with a grain of salt. The honest answer is, we don't know which one wins. But the way I see it, when the safest asset in the world and the riskiest assets in the world are telling opposite stories, it pays to know they're both talking. So here's what I'm watching. 3 signals. 1, the 30-year yield itself. Does it break above 5.5% toward Newton's 5.6, or does it cool off? 2, the next inflation print and the September Fed meeting. Does Warsh finally give guidance or stay silent? And 3, AI companies. Do they shrug off higher rates or do they finally flinch? If yields keep climbing and the AI trade cracks at the same time, that's your scenario 2 signal. If yields settle and earnings hold, the bulls were right. Watch those 3 and you'll understand this story before the headlines catch up. Thank you so much for watching. I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already, and I'll see you next time. Take care.